Good evening, ladies and gentlemen. Welcome to the dialogue with Dr. Paul Volcker. The chair for the dialogue is Professor Kishore Mahbubani, Dean of the Kuan Yew School of Public Policy. Please welcome Dr. Volcker and Professor Mahbubani to the stage.
Once again, it gives me great pleasure to welcome you to this dialogue with Paul Volcker. Those of you who know that as Dean of the Kuan Yew School of Public Policy, I just make 3 points in my introductory remarks. The first point, of course, is that this discussion could not be more timely because, as you know, we live in very uncertain times, especially uncertain financial times, uncertain economic times. And frankly, we live in an era when even the experts are lost. And all of us, frankly, are groping for answers to the state of the world. And of course, this brings me to my second point, which is the best person in the whole world, and I'm not exaggerating, Paul, who can actually guide us through these uncertain times is Mr. Paul Volcker. As you all know, he has had a very distinguished career. He was head of the Fed in very tumultuous times under both President Carter and President Reagan. I actually met Paul Volcker, of course he doesn't remember this, in 1983 when I accompanied Dr. Goh Keng Swee to visit Washington, D.C., and I was the note taker in the room. And I remember Dr. Goh Keng Swee treated Paul Volcker with great respect and admiration. And he said to me as we walked out, "Kishore, you realize you've just spoken to the most important man in the whole world." And most people, when they leave office, their stature goes down. Somewhat miraculously, in the case of Paul Volcker, his stature keeps going up and up and up. And frankly, as you know, he continues to occupy many important positions. He's head of the President's Economic Recovery Advisory Board. He's chairman of the Board of Trustees of the influential group of 30. He's a member of the Trilateral Commission. He's also chairman, by the way, of the Financial Services Volunteer Corps. And I'm pleased to welcome to this podium, to this auditorium here, the members of the Financial Services Volunteer Corps, who's also in Singapore here for a conference at our school. Now, equally importantly, he has been a member of the governing board of the Kuan Yew School of Public Policy, and he's been a very strong supporter of the school, and he's been coming every year for our board meetings. And for that, please join me in thanking Paul Volcker for this. The third and final point I'm going to make is that I'm going to begin with a horrible confession, which is that in this field, I am not an expert. So you'll discover that I'll be exposing my ignorance very soon. But I discovered it's not so bad because even the experts themselves don't know what's happening. So if I ask silly questions, maybe it might be helpful in bringing out what's really happening in the world. I did warn Paul that I have consulted some of my very brainy friends who gave me some very tough questions to ask Paul. So with that, I'm going to begin my, if you don't mind, friendly grilling.
So let me say, I thank you for those very generous comments, but I had a certain thrill as I came up here and saw that there was a pad up here. I thought maybe you would have the answers. The pad is full of blank. What good does it do me? I proceed.
Yeah, thank you. I think, Paul, maybe useful for us to begin this conversation with a kind of, if you don't mind, your own sort of broad-based assessment of where we are today in the world, the global economy. Are we going up, down, sideways? What's happening to the global economy?
Well, it's not a very happy story. I could say a four-letter word, like it's in a mess. I don't know if it's quite that bad, but we are, economically, we are tilted up, but it's a very slight tilt compared to usual recoveries. We've had a big recession, but not a typical recession. It is complicated to understate it by a massive breakdown in the financial system, at least in the developed world, and certainly in New York and in London and in Europe. And the combination of a recession with a financial breakdown is bad news. But in a way, it's worse than that. This recession and financial breakdown, I think, reflects the culmination of some continuing imbalances in the world economy. And when we say the world economy, we certainly mean the United States, still an important actor, but increasingly means also Asia. China in particular, but Asia generally. It's an old story. The United States consuming too much, borrowing too much, having easy money, partly as a result of the ability or willingness of China and other Asian countries, Japan to some extent, the Middle East, lend money to the United States very freely at low interest rates, help support our excessive consumption, and builds up. You know, I still find it very uncomfortable to talk about trillions of dollars. Trillions is too big a number to be associated with dollars. You used to think of trillions of yen, but not trillions of dollars. I don't like talking about trillions. But we've had a buildup of trillions of dollars in the hands of foreign governments. And that's not a stable situation. It couldn't go on forever, and we now have kind of been caught up short by the financial crisis. But underlying the financial crisis was excessive consumption in the United States, arguably excessive investment or excessive underconsumption in China, to take the counterpart. And a number of things are representative of a very different world. 15 years ago, we would not have thought of China as being big enough. It's always big population, big country, but not big enough on the economic scene to be part of a big international imbalance. But now we have a world that's topsy-turvy in a way. Asia continues to grow almost right through the crisis. The whole developed world not growing very well. But we're in, I think, a slow recovery. Slow because we had a big financial crisis. Slow because we've had too much indebtedness, which we have to work our way through. And slow because we have these big underlying problems of too much consumption in the United States, too little consumption in parts of Asia. It's a big challenge to get through all this, and if we get through it all with some growth, that's fine. It's necessary. But it's not a vibrant economy.
You know what? Given this situation, as you know, there are various discussions of what can be done to improve the situation. Earlier, we were discussing something called quantitative easing, QE. And you mentioned you were on the QE2 many years ago, but there was a cruise liner.
Yeah, I know.
Now we're talking about a different kind of QE. What exactly?
I've been on that old QE2. I don't know about the new one.
What exactly is this QE?
Well,
what would be the impact on the world?
You know, I'm out of it these days. I just read the newspapers. But there's a lot of talk about QE2, which I think is an expression that started in Japan a decade or so ago when Japan got interest rates down to zero or close to it, and you think of expansive monetary policies, easy money policies as driving interest rates down. Well, when you got interest rates down to zero or close to it, there's no place to drive them anymore. But you continue to ease, right? Quantitative easing is just continuing to ease, meaning creating more high-powered money in return for whatever asset you buy. And what has a lot of people, captured the attention of a lot of people, is that the Federal Reserve did buy a lot of longer-term Treasury securities. More than that, they bought a lot of mortgage securities in the midst of the crisis to kind of put a floor under the markets. Now they're apparently, who knows, I guess they're talking about it today, the meeting is today, buying, question, I don't know how much or whether they'll do it, but talking about buying longer-term Treasury securities. That's a way of creating more money. It doesn't alarm me that they're talking about buying Treasury securities. It's the volume which they choose to do it, and we don't know what that is. But it's a further effort to ease. When you get interest rates as low as they are, they can't go much lower. So I don't look for any overpowering results of this action. And it does worry people that it's okay now, but we're going to create so much money that down the road will create inflation. And that's something that's always worth worrying about, but I don't think it's beyond the capacity of the central bank to deal with that problem in the future. But they're going to have to deal with it.
So you don't see that as a long-term?
Well, it's a long-term challenge, but it's not a challenge that's dealing with inflation. Inflation potential is always a challenge. It's a challenge all my life. It's not going to stop being a challenge to me. But it is manageable, but it's not, doesn't mean it's easy.
What would your advice be to the administration now? What would you advise them to do, given the present situation?
My advice to the country would be have patience. There's nothing that's going to cure this economy in the short run. We are going to have, hopefully, some continuing growth, but are we going to have enough growth to put the unemployment rate down in a hurry, which is what people would like to see? Are we going to create a lot of jobs in the short run? Well, I hope we create some. But the chances of having a recovery of the kind we had in the mid-1980s, we had a severe recession. Within 6 months or so, after the recession was over, the economy was growing 5% a quarter at an annual rate. 5%, 6%, 7%, 8% for a couple of years. I think the chance, and the unemployment rate going down, employment going up, I think the chances of that happening now are limited, to say the least, very limited.
That one of the things that's happening in Washington, D.C., as you know, and you see this in the president elections that are going to take place today, is a kind of an effort to try and blame China for many of these problems, you know. And many Americans say that all these problems will be solved if China could appreciate renminbi. What do you think of that?
Well, I think there's some danger, you know, all this gets politicized, and if it makes a kind of fight between America and China, that's unfortunate. China is a big economy now. You can't, second biggest economy in the world, so you can't say they're not there. But in fact, we were discussing a little earlier this afternoon from the Chinese standpoint, I think. They don't want to get uncompetitive with respect to the rest of Asia. They're closely linked with Asia. They import a lot from Asia. I believe they're in deficit with Asia. And so they don't want to get out, as I understand it, I maybe don't understand it, but the Chinese don't want to get out and take big measures with exchange rates or otherwise that makes them uncompetitive in Asia. I can sit here and say, how can China worry about being uncompetitive any place? They're so competitive in the world economy. But the fact is they're not alone, and there is a challenge, I think, for rebalancing the rest of the world with Asia. By the rest of the world, I certainly mean the United States. But it's not just China, it's Asia more generally, not Japan, but...
It's becoming very clear that to solve many of these problems, no country can do it by itself. That you require more and more coordination within different countries. And the problem is that most of the governments are driven by domestic agendas, but they have to sort of coordinate, they have to take care of the global agenda too. So how do you see that problem being solved? Will the G20 do it?
I mean, just to illustrate the problem, in this whole century, 10 years, the early part of the century, the United States kept spending beyond its means. Asia kept producing more than it could absorb, and it exported. And you could see that was a train wreck ready to happen because the United States was borrowing too much. The other countries were too dependent upon selling to the United States. But it was very convenient, so who wanted to change it? I mean, neither the United States nor Asian countries were willing to take the actions that would have been necessary because in the very short run, it suited everybody's convenience. But at the end of the day, something was going to happen. What happens typically in these situations, sooner or later you have a financial crisis. And it was so easy to borrow money in the United States, we had a big bubble in the housing market. We had very weak credit standards because there was so much money around and interest rates were so low, house prices were going up. Why worry about being repaid? You can always sell the house, buy another one. But that couldn't last either. And when that began, when that particular bubble burst, the whole facade fell apart, including the underlying imbalance that made it so easy for us to borrow and so easy for Asia to sell. And so we got to readjust.
What would you have done differently?
Oh, I would have solved it all. I mean, never would have happened. I mean, I would have said, we got to have a little more discipline here.
Why did they listen to you?
Well, I find it very difficult personally to consume, but I'm not the typical American, so I couldn't solve this problem.
Yeah. You know, one of the things that has come up, this is what we're going to discuss here, the financial sector reform that has happened. No? Do you believe that the Financial Reform Act, which has just been passed, will it significantly change the behavior of the Wall Street banks, or will it not?
Well, first of all, the crisis itself should have changed behavior of Wall Street banks. Maybe not enough. Yeah. But obviously that raised enough questions, so whether you had some reform or not, we're not going to, I don't know why I say this, because it may not be true. I was going to say, we're not going to run into subprime mortgages in a hurry because the whole facade upon which that was based is shattered, namely the inevitable rise in housing prices. But we have enacted some legislation that I think goes in the direction of changing behavior. I certainly hope so. What all the countries together are doing off in Basel to raise capital requirements should affect behavior, whether it's strong enough medicine, promptly enough, I don't know, but they're doing something. So I think we will see some changes in behavior, but if you ask me whether all the attitudes on Wall Street have changed, I think, unfortunately, the answer is no, not yet.
Why
sufficiently.
Not? Why not? I thought they'd be sufficient.
Because they made a lot of money. I mean, it's as simple as that. Why should we change? They got used to making millions and millions of dollars. And, from the standpoint of somebody making millions of dollars, why don't we keep it going? That's pretty good stuff. So, that attitude hasn't changed.
But that creates another imbalance in the United States, right? I mean, the creators of value in an economy are supposed to be agriculture and industry, and the financial sector is supposed to support the main economy. But now you have a situation where the financial sector takes up 40% of corporate profits. So how do you change that balance again?
Well, I can orate about this at great length because I think it is symptomatic of the problem. Finance at one point got to 40% of 1 year by one measure, or whatever it was. It got into the high 30s, 30% or more, much higher than it had ever been historically. And when you say it got to 30 or 40% of all the profits in the country, that doesn't count profits come after all the pay that was made, all the millions of dollars that were made by the so-called workers on Wall Street. And they do work pretty hard. And this really got out of balance. We had too many resources going into finance. They ended up making a lot of money. That's why they were there. They were attracted by a lot of money. But there is a serious question as to the value of all that concentration and good fortune in the world of finance in terms of the whole economy. I have offered a prize to the first PhD thesis that demonstrates to me that all these resources put into finance had any visible positive effect on the economy as a whole. And I cite the fact that all this resource went to finance. All the smartest people in graduating from college, including my grandson, go into finance. And what's the result? The economy was growing no faster in these years than it grew earlier. Productivity was actually a little slower in the past 10 years than it was in the previous 10 years. The growth rate of the economy as a whole was not exceptional, and it all ended up with a big crash. Now, that can't be a productive, healthy situation. Finance became enormously complicated. It got taken over with the great attraction of so-called financial engineering. If you were good at mathematics, if you showed promise as a physicist, if you were a good engineer, you didn't want to do physics, you didn't want to do engineering, you wanted to go in finance and make a lot of money. And you adopted very sophisticated mathematical techniques that were alleged to distribute risk, eliminate risk, place risk with people that were willing to undertake the risk. And it was supposed to be marvelous, help the economy. Well, there's no indication it helped the economy. There's no indication that it really diffused risk. When the crisis came, the risks looked more concentrated and more exposed. So, it's a long lecture, but I think we put much too many resources into finance. It was too richly rewarded. And that's a big adjustment that has to be made. We can't go back to that system. That's part of what this whole effort of reform is designed to ameliorate. Now, is there resistance? Yes. And the people making all that money aren't going to walk away very, very easily.
You know, I know you once famously said that the only significant innovation that the financial industry has produced is the ATM machine.
It's the most insightful thing I ever said.
But, you know, you also, you know, you must make a lot of bankers very unhappy with you, right?
Well, I don't think they were particularly pleased by that comparison, but you know, get a little bit of philosophical about this. A lot of mathematically trained talent moved to financial markets based upon a lot of theorizing that by the application of these mathematical concepts, you could improve the efficiency of markets, that markets would be very efficient, they would be automatically self-stabilizing, that operators in the markets were rational, and by removing, in fact, restraints and restrictions on the market, you would have a blossoming of not just finance, but the economy. Now, in retrospect, it doesn't look like it really worked out that way because I think there was a fundamental misunderstanding. A lot of this structure was based upon the notion there are kind of repetitive patterns that could be assessed statistically and otherwise, subject to analytic techniques, and the risks measured and dealt with. Just to get a little technical, if you're a mathematician, all behavior looks like it follows a normal distribution pattern. You know, this nice curve, the bell-shaped curve. And that's what happens when you flip coins or when you're measuring physical activity, physical properties. Your error of measurement may be a little bit off, but you have a very strong normal distribution curve. And that's the way the risk management systems were applied to finance. They forgot one thing, that financial markets are not physical phenomena. So when you flip a coin and you come up heads, it doesn't tell you what the next flip is going to come up with. It's a physical thing you're not going to affect. But financial markets are affected. If they come up heads one day and they come up heads the next day, people say, oh, the market's coming up heads, so I'll bet on heads. But in financial markets, people react to what happened yesterday. And that's not what happens with physical phenomena. That's not what happens with mathematical. There's a human being in there that's screwing it up, so to speak. And when they attempt to apply the mathematical concepts, it doesn't work. And so you say, take the housing bubble. You apply some of these techniques where housing goes up every month for a year. It looks like you're going to continue. So that works into the equations. It goes up for 2 years, the equation gets even stronger. And then something happens, it goes in the other direction. They say, my God, you know, that shouldn't happen. That should only happen once every 100 years in a normal frequency distribution. And how many times you heard the expression in recent years, you know, that was supposed to be a one-in-a-century phenomenon. It's coming up every 10 years. It tells you something's the matter. That was more than you wanted to know, but I think there's a basic intellectual flaw, which is now understood, fortunately, in the whole assessment of financial.
So how will it significantly change the industry? Before I forget, by the way, I'll be carrying on for another 10 minutes or so, then I'll be throwing the floor open for questions. Please be ready with some equally challenging questions for Paul too. But, you know, given the mood in the United States, as you know, the political mood in the United States is so angry with the banks, right? You see that in all the ads, and all the politicians are running against the banks. You're saying that something has gone wrong there, and yet the reforms fundamentally fail to change the situation. Why?
Well, the situation is changing. It may not change as fast as you want it to change.
But look at your Volcker rule, for example. Do you think that the Volcker rule, you know, the Volcker rule that you...
Oh, that's a terrific rule. But
by the way, normally he's very modest, you know.
This guy, I've already gotten technical. This is too technical. But, I mean, basically, I think there is a difference between banks that are essential to our economies for a variety of reasons. Principal lenders, particularly to small and medium-sized businesses, they handle the payment system. In fact, you can go into I can go into the automatic teller machine across the street from the hotel and stick my credit card in, and 15 seconds later, out comes Singapore dollars. I mean, that's what banks do for you. They move money around, and they are central to monetary policy. Meanwhile, other parts of the market developed, partly with all this financial engineering. And more speculative type activity was developing, and very profitable for a while. But the question is, should that speculative type of activity be conducted in commercial banks that are essential to the operation of the economy? And it was all getting mixed up. So my effort, and what many other people think, is no, let's separate out the speculative activity from the banking system. Banking system has to allocate credit in a responsible way to people who can use that credit. It shouldn't be a casino. And much of the rest of the market has some of the attributes of a casino, but let's keep them separate.
But now they're busy writing the rules, right? Am I correct?
Pardon me?
They're busy writing the rules now to implement the Volcker rule.
Yes.
And are you confident that when they write the rules that they will achieve what you set out to
Well,
achieve?
I will do my best to try to
You're going to push very hard.
encourage that answer, yes. No, but I think the law, certain ambiguity in some parts of the law is very complicated, and it leaves a lot to the regulators, not just in this area, but in other areas. It's going to be an enormous, too complicated job of writing the regulations. But when it comes to the basic question, should so-called proprietary trading be permitted in banks? The legislation is pretty clear. The starting point is no. How you apply that restriction is up to the regulators, but the rule is pretty clear, no. There are exceptions for government securities and foreign exchange. But otherwise, where there's no clear exception, the answer is no. It's up to the regulators to enforce that.
Can I just shift the topic to something else related? Fannie Mae and Freddie Mac. What's happening there?
Well, they're kaput. They should be.
Sorry?
They're on the way to being kaput.
Kaput? Oh.
You know what that word means.
Yeah.
Well, Fannie Mae and Freddie Mac were in this ambiguous position of being half free and half not free. It never should have been created. The hybrid organizations that people assumed had public support, but they also assumed that they were profit-making. And in good times, their objective was to make profits. In bad times, they fell back on the government. That is not the kind of institution you want, but they became very big, and the whole mortgage market became dependent upon them. Now, in the crisis, they fell apart. The government took them over. They still exist, but they are now, for all practical purposes, government agencies. 90% of the mortgage market in the United States is run now, the residential mortgage market is government run. Simple as that. As unhappy as that is. The residential mortgage market is the biggest part of our capital market. And now it's kind of a wholly owned subsidiary of the United States government. I think, fortunately, you asked whether there are any changes. I think there is an understanding no more hybrid institutions like Fannie Mae and Freddie Mac. Now, that's fine, but you got to rebuild something.
But how do you shut them down?
Well, you can't.
You can.
But they're now basically government institutions, so you got to run them off. You can't shut them down tomorrow. The whole mortgage market depends upon it. Right. It wasn't dealt with in this financial reform because it was understood you can't shut them down, and it's a big problem. How do we wean ourselves away from dependence on government agencies into a private market that we were always so proud of? Now, obviously, that can be done, but it's not going to be done. It's not going to be done this year. It's not going to be done next year. Hopefully, it'll begin, let's say, in a couple of years, that process of weaning away will have to begin.
One last question from me before we go to the floor. You know, there is one of the most surprising things that's being reported in the media is that President Obama has developed a reputation of being anti-business. And many businessmen are rather critical of him. What's your reaction to that? Because in many ways, many of the major American business corporations are sitting on large hoards of cash, which they're not investing.
I frankly don't understand it, because I don't think he is basically anti-business. Now, he obviously has made critical speeches, critical remarks about the world of banking and finance. Well, you know, any political leader is going to do that because he's got to make a case for change and reform. And he doesn't have to make the case is there, right? And there's a lot of anger about the financial markets. But the interpretation that he is anti-business generally, is a misconception. He has not done some things that the business community would like to see done for various reasons. I'll tell you one that begins to stick out more of a sore thumb. Our system of corporate taxation in the United States is clumsy, inefficient, unfair, and inequitable. I can't think of what other words I can think of. And the tax rate is too high.
Nice.
And it particularly hurts international businesses in the way it affects their international operations, in a way that hurts them competitively. I think the president understands this. He didn't feel that he, for whatever reason, could handle it this year. But that doesn't, you know, that's a judgment he had to make. That doesn't mean that he's not interested in the subject, doesn't have some understanding of what the problem is. Another one, this is a political judgment. We have these free trade agreements with Colombia and Korea, Panama, that have been negotiated but never approved by the Congress. And he has not pushed those with the Congress because I suppose he felt it would be very divisive. I might note that President Bush negotiated agreements, but he never pushed them in the Congress either. Now, he didn't have that much time. Now, these agreements are not terribly important in the whole scheme of things. The trade with the United States with Panama and Colombia is not huge, but it was symbolic of, taken as symbolic of a kind of, if not anti-trade, not strongly pro-trade. But that's not enough to justify this depth of
Anger.
that
As you know, tomorrow the anger will be seen when you get the results of the midterm elections, right? The results of the midterm elections will be tomorrow.
Yes, well, you see it coming to a climax.
You can see everybody predicts a lot of anger against.
Obviously, people are unhappy and frustrated. They're unemployed. They're worrying about their jobs. Yeah. We have had no, very unusual phenomenon historically. We've had growth in the economy in this century, the first decade of the century, until the recession, of kind of normal 2.5%, 3% in real terms. But the average family in the United States has no real increase in income after inflation, in real terms, for more than a decade. All the increase in real income has gone to the top 10%. And a big portion of it went to the top 1%. And a not insignificant portion went to the top 100th of 1%. The income distribution got way out of whack in most terms. And so there's kind of a built-in frustration about this, which
you see coming out in the elections.
Come out in an odd way in this election.
Great. Now let's turn to the audience, and who would like to ask the first question?
Thank you very much for the opportunity.
Can you identify yourself, please, if you
yes,
don't mind?
my name is Mikio Kumada. I work as a market strategist for LGT Capital Management here in Singapore. We're a Swiss asset management company. My question, Mr. Volcker, would be, let's suppose you are all powerful for 1 hour or 2 hours. You could do anything. What is the single, and you had an option to just change one thing in current economic affairs globally, not just maybe, I mean, preferably perhaps in the United States, but you know, the economy today is global. So what would you change, or how would you intervene? That would be my question.
Pretend you're God.
Well, I'm God. And I want to give advice to the population out there. Be patient.
But you got to change one thing. Change one thing. Change one thing.
Well,
what's the one thing you change?
That's what I'm changing. They're not patient now. That would be a big change. That's it.
So you don't see a quick
there
fix.
is no magic bullet here.
There's no magic bullet.
You know, I think these adjustments that we talk about will take time. You can't reform the financial markets overnight. We just talked about Fannie Mae and Freddie Mac. Yeah. I hope 10 years from now, those organizations are history. People won't think about them. But I can be all the God I want, and I say they go away tomorrow. Who's going to buy all the mortgages that are being created? There's nobody else out there right now that can buy them. So you got to give me more than one thing. You got to give me, okay, one to say Fannie Mae and Freddie Mac go away, And number two is who's going to buy them? I got to create a big new institution. That's two things.
Okay. Over here, please. Yes.
Dispense with the niceties, all
We'll
right.
forgive you. We'll forgive you.
Okay, I have two questions. My first question is, if
You
you look
only
at the
permitted one.
sorry, I know. So if you allow me to be greedy, 'cause, well, anyway. So my first question is, if you look at the Volcker rule, right? Did you ever consider looking at it from the perspective of aligning incentives, which was instead of going the extreme step of asking the banks to just go cold turkey and not do any prop trading,
Right.
would you go at it from the perspective of saying, well, let's align the incentive to maximize profitability with the incentive to flow profits to shareholders? So in other words, put in something like a REIT model, where if a bank's prop desk crosses a certain level of profitability, a chunk of that has to go to the shareholders. Now, before you say that's a bad idea because people are used to bailouts, doesn't that give you moral basis to say, well, I can't do a bailout because the shareholders will accept the risk? So that's my question. Would you?
Well, I presume I haven't lost all faith in capitalism. When they did the proprietary trading, they made money. It goes into the general profits of the bank, which presumably might trickle down to the shareholders a bit now. But it's characteristic of that type of trading that the guys doing it get a large share of the profits. There's no doubt about that. And that's why it's so popular, because the concentrated return. And the problem is, particularly when it's a big organization, they take a big share of the profits and they take none of the losses. They might, if they do a really bad job, get fired, but if it's just for a year or two, they probably don't even get fired. So it's a very unsymmetrical situation. These people, you know, they want to go off and do that kind of thing, okay, but they shouldn't be doing it on the basis of bank capital with a one-way bet, which is, I think, the way it is now, or the way it was.
Next question.
Thank you, Mr. Mahbubani. Tom Rowe from the European Union. I'm attached to the Lee Kuan Yew School for a year now. Dr. Volcker, if I could just comment on being God, a man as tall as you, John Maynard Keynes once said that in the long run we're all dead, so being patient is a difficult problem. But I'd like to also point out that most of the discussion, and that's your expertise now today, is about the financial sector, financial adjustment. But what about the real economy? What are Americans and Europeans and probably Japanese, what are we looking at in terms of real adjustments? You're talking about financial reform, but there are going to be some real adjustments to this.
Oh, you're absolutely right. We have to make real adjustments. That's my whole song, and if it didn't come through, I want to sing it again. We're going to have to consume relatively less. We're going to have to invest relatively more. We got a lot of infrastructure to work on in the United States, too. We're going to invest more, and we've got to export more. And to export more, we've got to produce more. And that means more manufacturing. We've got our manufacturing's never going to be where it used to be in the United States and many other countries. But it's got to be a little more than it has been, so that we have more to export and less to consume ourselves. Or we need more manufacturing to satisfy some of our consumption at home. So that's absolutely basic. The financial stuff is all froth, and that's got us screwed up in a way. But basically, we have an economic adjustment to make. But I think, in fairness, some Asian countries have an economic adjustment to make, too. China can't go on, I hate to pick on China and make it look bilateral, but in fact they're the outstanding example of a country. I'm told Singapore is almost as bad, if that's right.
Excuse me, it's as good.
Good, yeah, good and bad. It's all a matter of perspective, but with China the figures are nice and symmetrical. The United States got to consuming 70% of our GDP. China, big country, second biggest economy in the world, consumes 35% of their GDP. I mean, that is a discrepancy that reflects a big lack of adjustment on both sides. Now, they don't have to go to where we are. We don't have to go to where they are. But we're both too extreme. And somebody told me to say that Singapore only consumes 30%.
I'm not quite sure what the figure is.
But, you know, if that's true, you're going to have adjustment here, too.
Singaporeans, by the way, do consume a lot.
Well, I thought so, but they tell me that's all the foreigners coming to buy.
Can I just build on this? Remember at the FSVC meeting we had earlier on, one of the Chinese participants suggested that one of the best ways to help jumpstart the American economy is for the United States to allow Chinese investment in the real economy and not just ask the Chinese to buy treasury bills and equities, whatever it is. Let the Chinese come in and build your infrastructure and set up factories and buy your companies. But there's a huge political resistance in America to that. So what will you do about that?
I understand the problem. There was this famous case where China wanted to buy an oil company, I guess. It aroused some political opposition. I forget whether a law was passed, but anyway, it stopped. I can't say our record is perfect. It obviously isn't. But I think there are a lot of areas where we ought to welcome any foreign investment, including from China, as part of this adjustment we're just talking about.
Yes.
If somebody can come and produce investment in the United States that we're not generating ourselves, or take over an American company and do a more efficient job at running that company, making more money and inducing more investment by that company, that is part of the adjustment we have to make. And we can, if you don't like it that it's a foreigner, we got lots of foreign investment in the United States, we can kick ourselves that we're not saving enough to do all that investment ourselves. Yeah. But that is what should be done. We ought to get more investment wherever the money comes from.
Great. Next gentleman at the end, please.
I'm a student in Singapore from Hwa Chong Institution. I'd like to ask Dr. Volcker, with the midterm elections coming, and we know that the Tea Party is a major movement in the United States, and we know that they like to reject governmental intervention in the state of economy. What do you think will be the effect on US financial markets if the Tea Party candidates do win a majority in the House of Representatives this midterm elections?
The Tea Party representatives. What will be the implications for the United States if the Tea Party representatives win a majority? I think that the Tea Party themselves will not win a majority. The Republican Party will win a majority, of which a small component of it will be the Tea Party, I think. But if the Tea Party succeeds a lot, what will be the implications for the United States?
I am dumb in some ways, but I'm not so dumb as to forecast what's going to happen in an election that takes place 12 hours from now and prove me wrong. That's it.
It's a hypothetical question. What would the implications be if they do well?
Too hypothetical.
Thank you. Okay, we'll skip that one. Over here, please. Yes.
Good evening, Dr. Volcker. My name is Joseph Tan. I really enjoyed your very candid discussion. I have one question, but it's in two parts.
Then you better make it quick.
I think we're all very familiar with the role that banks played in this crisis, and it's very easy to demonize them. But what about central banks? Are they equally culpable? Did your successors leave liquidity in a system for too long that, banks, being who they are, will do what they do best? And is that one of the key reasons for this crisis as well? And the second part of the question is, now that we have successfully busted the economy with such woomph, and we are still throwing big money at the same problem, are we in danger of encouraging moral hazard? And is there any guarantee that after we throw all this money, we will somehow be saved? Thank you.
I'm not sure that was two parts of one question, or two separate questions, but we'll answer it anyway.
He's smarter than you. Yeah. He got his two questions in.
Let me, in the first part of your question, here's the way I would approach that. We had this underlying imbalance that was going to create a crisis sooner or later, in my opinion anyway, and that is not particularly a responsibility of the banks or anything else. It was a failure of broader policy. We had a failure of regulation. I think it's fair to say the regulators were not decisive in dealing with impending problems. Partly as a matter of kind of ideology. They thought the market could take care of itself. So there's lots of room for criticizing the regulators. You can raise a question about monetary policy. Was it too easy? Well, that gets you to a question of how much was that a function of monetary policy? How much was a function of the basic imbalance where all this money was coming from abroad? All the foreign savings were flooding into the United States at very low interest rates, and certainly inciting the bubble in the housing market. So I haven't gotten to the failure of the financial markets yet. The three big problems. I think what you can say, when the financial markets came under pressure, it collapsed. Collapse is hardly too strong a word. It got rescued by the injection, not just in the United States, but elsewhere, of literally trillions of official money went in to support private financial markets. Well, the underlying factors were there. You're absolutely right. But when push came to shove, the financial markets did collapse under the pressure. And so that needs to be repaired. We don't want financial markets that are not robust and sturdy enough to stand the pressure. Now,
comment a bit about moral hazard, because it seems that we haven't been fixing the problem.
To short circuit the answer quickly, it's a very important question that so much assistance was given to the financial institutions and financial markets during the crisis in the United States and in Europe and elsewhere, and so a lot of creditors were saved, a certain number of stockholders were saved, managements were saved. Does that give rise to so-called moral hazard that in the future more people will take a risk and do too much leverage, too much risky activity, too much faith in financial engineering, because they will anticipate getting saved the next time? It's the central question of financial reform. And all I can say is I think the law that was passed in the United States, the so-called Dodd-Frank Act, attempts to deal with that problem. And it attempts to deal with it in a way that, philosophically anyway, is in tune with what Europe is thinking. Europe hasn't enacted a similar law yet, but they talk about it. And I don't know, I don't want to go into a great description, but it basically says if a significant financial institution comes under pressure and it's failing, and it's so big it would be disturbing, the government can take it over right away and put it into liquidation. And that is a different situation than what happened in 2008. Put in liquidation means the stockholders are gone, the management will be gone, and the creditors are at risk. So that is a straightforward attempt to deal with the problem of moral hazard.
But that's what they did with Lehman Brothers, right?
Pardon me?
That's what they did with Lehman Brothers. They shut it down.
That's right. Well, but Lehman Brothers was just shut down without any government support. This says the government will take it over. The government will meet, in the case of Lehman, it would meet the overnight obligations or the immediate obligations that Lehman had. There was great concern about how to settle their credit default swaps. And they would settle those, not spelled out just how long, for the first few days anyway, and give the market time to adjust, but then put it into liquidation.
A lady, please.
I have a question in relationship to what does Singapore have to learn from the United States currently, and vice versa? What does the United States have to learn from Singapore moving forward, not necessarily historically, but moving forward, let's say the next 5 to 10 years?
Well, actually, I think there's quite a lot we can learn from Singapore. One of my concerns about the United States and other countries is having an efficient, effective civil service. And I am led to believe that Singapore does a pretty good job.
Number one.
And they've got this, per capita, they got one of the strongest schools of public policy and public administration. And, but it's known as a, a place that's in an area of the world that has lots of corruption, a place that is clean and has very little corruption and efficient. And I think there's a pride in the civil service here and in government that we've lost in the United States pretty fundamentally. Now, I don't know, we spent a lot of time trying to be an example for Singapore in some respects of fancy financial markets. Maybe we've gone far enough in that direction. I don't want to teach Singapore anything more about financial engineering. Or, so maybe I'll just leave it at that.
Okay, Declan, we'll come to you after we go around, please.
Good afternoon. I'm Vinod Tanwani. I'm a student at what you called as the strongest school of public policy. I have an ethical question here, that the incentive structure of the financial market was so skewed that in a way it ended up making all the sharpest mind perhaps the greediest also. Where is the world headed if the sharpest mind end up being the greediest also? Are we headed in the right direction?
But no, what happens if the best minds in the world also become the greediest minds in the world?
Greediest.
Yeah. So that's basically what happened with the financial engineering and so on and so forth. How do you get rid of greed?
Well,
simple question.
I don't think we're going to get rid of greed. All I asked for was patience, not getting rid of greed. But I think the rewards did get terribly skewed. We never had, entrepreneurs always got well rewarded. I mean, take Microsoft or Google. I mean, these were entrepreneurial triumphs that had an enormous impact on the real economy and on the ability to do business and communicate and all the rest. And traditionally, success, and so dramatic as that, gets very well rewarded. But these rewards basically for trading activity, which discussed earlier, I find a little difficult to trace enormous benefits to the economy, are kind of abnormal in the size that they were created. So I think the effort is you create a structure in the market that doesn't produce those kinds of rewards so regularly. And that's part of what taking speculation out of commercial banking is all about. But connects up with the moral hazard problem. That speculation will go on, in some sense it should go on, but in an environment where it's not, heads I win, tails the government loses, but heads I win or tails I lose in a competitive private marketplace. And that's what this reform effort is all about. And we'll see whether it's successful. But it's clear what the problem is and what the effort is. The best answer well, it's not the only answer, but you're going to have higher capital requirements on big institutions. You're going to have safer means of dealing with derivatives. I mean, one of the excesses of the market that became so marked was the fact that in 2007, I guess, credit default swaps were only invented, say 15 years ago, but it's probably less than 15 years ago. They didn't exist. They were invented for a particular purpose of providing insurance against particular credits. In 2007, there were $60 trillion of credit default swaps outstanding against maybe $10 trillion worth of credits. So obviously they'd become a kind of speculative plaything in the market. They were created out of nothing for trading purposes. So-called, you had derivatives, which are already, by their nature, they're a derivative of something real. And then you had derivatives of derivatives, synthetic derivatives. I mean, the imagination of financial engineers knew no bounds. And it all got distorted, and when it came under pressure, it collapsed.
Oh, you got the answer. Over there, please. Yes.
Yes, hello, sir. My name's Jonathan. I'm from the United States. I'm just a simple businessman. One of the things, before I ask my question, is I think it's important to...
The whole purpose of reform is to have more simple businessmen.
Yes, that's right. So I very much am in that boundary.
We want more of you.
Yes. So I think simply, and I also am not that intellectual, but I would like to, before I ask my question, say this to you, is that your service and your commitment to our country, as a fellow American, I think it's important to express thanks to you, because you're a very ethical person, and you've demonstrated that you're not selfish in your public service to the country. So I think it's something to take note of and appreciate.
Yeah.
And that said, I hope you'll indulge me in the question that I asked.
I hesitate to say, maybe I'm greedy in another way.
Okay, so my question is this, is that, magically from the founding of our country to 1913, when the Federal Reserve was actually created, the country survived in some way. It became the United States. It became a pretty successful country in the early 1900s. Right. And magically in 1913, the Federal Reserve was created. And after that, you had things like the Great Depression, the financial crisis of the 1970s, and also the Great Recession. And so my question, which may be an obtuse question, but considering the fact that the Tea Party movement, which I have to disclose, I'm a big financial supporter of the Tea Party movement. One of the big planks of the Tea Party movement is essentially the elimination or the abolishing of the Federal Reserve itself. And while it may seem funny and may seem kind of playful, the fact is that within the next 24 hours, something big and dramatic will happen in U.S. politics. Maybe I'm not so smart, but I'm making a somewhat of a prediction. Now, my question to you is, and I know that you're a very ethical person and very intellectually honest, is at what point do we start the assessment of looking at reform or abolishment of the Federal Reserve itself and look at replacing it with a system, say, like Singapore has, the Monetary Authority of Singapore, which as a monetary institution or as a de facto central bank, rather than actually setting interest rates, it manages monetary policy by foreign exchange rates. At what point do we look at the Federal Reserve and say that this is an institution that's managed by less than 20 people, that's controlling the financial future in many ways via setting interest rates arbitrarily for 300 million people? I mean, isn't it somewhat obtuse and somewhat counterintuitive to the idea of a free marketplace and also a free economic system?
How many people run the Monetary Authority of Singapore? One person, eh? Well, we could have a long philosophical argument about the importance of the Federal Reserve, original sin, Adam and Eve, and all that, but I think we're...
Well, I mean, it's important because the Tea Party movement, one of the big planks is the elimination of the Federal Reserve.
Well,
and in some cases, the idea is replacing it with nothing.
Yeah. Okay, okay. I mean, let's, do you think that America would be better off if we shut down the Fed? Do you think America would be better off if we shut down the Fed?
Shut down the Fed. Well, you got to ask me. The United States had a lot of experience. We created the central bank when it was brand new, and it got shut down. And it was recreated a few years later, and finally got shut down by President Johnson in the 1820s. And then we went through a long period of no central bank. And we have a central bank because people were very unhappy with what they saw, which happened to be a lot of ups and downs, some big depressions, a big crisis in 1907. They finally said, enough of this. We want a central bank that's independent and can have the authority to even things out. Now, has it worked successfully in the United States or elsewhere to cure all instability? Obviously not. Has it made mistakes? Well, there were times when it didn't, I firmly believe. But no, I don't think people are prepared to leave the financial system and the banking system without any overall supervision and without somebody able to come in the case of a crisis, this happened in 2007, 2008, and provide support for a financial system that had collapsed. If you can guarantee me that you're not going to have any more collapses of the financial system, maybe we can get along without the central bank, but I don't think we can blame the central bank for every problem with the financial system.
Thank you. Next one, please, over here.
Yeah,
We have to finish in 15 minutes, by the way. There are lots of questioners, so if you don't mind, keep it brief and we keep it moving here.
You mentioned earlier on that if you shut down Freddie and Fannie, then nobody can borrow, can have a mortgage anymore to buy a house. My question, why the obsession with government-sponsored home ownership? Second part, you're probably aware of research by the Kaufman Foundation that basically all jobs are created by private enterprises which are growing. Question as head of the Economic Recovery Advisory Board, is your board aware of this? And if so, how does bailing out General Motors, Wall Street banks, and so on help small private enterprises? Thank you.
Well, the first part of your question anyway, basically is why do we have an obsession about home ownership, which has led to a lot of support for the housing market and led to Fannie Mae and Freddie Mac. I think, you know, since the question is an appropriate question, which is being rethought. I think there is a feeling, even among people in the Congress who had been the strongest supporters of Fannie Mae, the strongest supporters of other assistance to the mortgage market and housing, are saying we went too far, we tried too hard, we did things that became counterproductive. So there's a rethinking of that. I think that's right. There should be a rethinking of it. You know, it's interesting. I don't want to make too much of this, but the United States historically has intervened a lot in the housing market, not just by Fannie Mae and Freddie Mac. We're the only, maybe other countries, but the major countries do not provide deductions for mortgage interest from the income tax. We do. Most countries, if the mortgagor fails to pay, he's at risk. In the United States, there's no recourse. The lender gets the house, but he doesn't get the wealth or the assets of the borrower. And there are other ways in which you can pay off a mortgage without paying any penalty in the United States. So people like to borrow for 30 years and keep it outstanding for 3 years. They go get another one at a cheaper rate if it happens to be possible. No other country that I know of provides so many benefits for the mortgagee than the United States. The interesting fact is home ownership is no higher in the United States than it is of, people think maybe the most comparable countries, Canada, Australia, and the UK. The 4 English-speaking countries all have about the same level of home ownership. The other countries do not provide nearly as much support, which raises some questions whether the support was really worthwhile in the first place. So I think it's a reasonable question. I think in the future we ought to provide less support, less kind of artificial support for the mortgage market.
Okay, Declan.
I'm Declan McFadden. I run the Asia region for an international business. I'm not in finance. We deal with very simple products. Yeah. I have a question on derivatives. You mentioned earlier on that you were scared when you started hearing people talk about trillions of dollars of debt. My question is you know, a lot of the non-mainstream economic forecasters and commentators talk that the elephant in the room is the size of the derivative mountain that the BIS says is now 650 trillion, and yet a couple of years ago it was about 1,100 trillion. So by some act of sheer magic, they got it down to 650 trillion, which is an horrendous figure when you see the global GDP at about 50 trillion. Now, is this an economic volcano that could implode on us, or is it not something we should worry about?
Well, you know, the numbers are so big, you don't know what to make of them, but those numbers get so big, and they're big enough that, with the credit default swap, which is the smallest part of, you know, the economic system, is 1% of GDP. 1% of GDP is 1 trillion. 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 1% of G That's 650 trillion or whatever you were mentioning. It depends upon how you define a derivative. And in those numbers, they have every forward transaction in the foreign exchange market is technically a derivative. But that stuff goes on every day in big volume. It's not necessarily risky, particularly risky, and a lot of that is done to genuinely hedge against changes in foreign exchange rates. A lot of it is so-called interest rate swaps. Those are the two biggest. Those are hundreds of trillions. But a straightforward interest rate swap, without going into details, it's not a big speculative deal. Somebody with a fixed rate mortgage, well, it would be an individual, but a company with a fixed rate mortgage might decide that he'd rather have a floating rate mortgage. You find somebody with a floating rate mortgage, just as soon have a fixed rate mortgage. So you make a trade. You do it through a derivative. It's not big volume, but it's not, I don't think, systemically important in terms of the risks involved.
So overall, do you see this as a volcano about to erupt, or do you see this? Do you see this as a volcano about to erupt? The derivatives?
No, not of those kinds of derivatives. No. Okay. I mean, a lot of it's probably useless. But
yeah. Gentleman over there, please. Yes.
Thank you. My name is Omkar Shrestha from Institute of Southeast Asian Studies. I was reading Stiglitz's newly edited book, The Free Fall, and this is what he had to say. Monetary policy has reached its limit. Further decline in interest rates are impossible or would not have much effect in stimulating the economy. We must then rely on fiscal policy to help restore the economy to health. That's what he had to say. Now my query is, do you agree with this view? If so, can you please explain the rationale behind QE2? Is the US risking the global currency status of the US dollar? Finally, if this fails, what else is left?
Well, your quotation was
Joseph Stiglitz.
Professor Stiglitz, yes, I had read that.
Free fall. Yeah.
Well, he is, Professor Stiglitz, as you know, has given the strong statements. But the basic point that he's making is shared by a lot of people. When you get interest rates as low as they are now, it's a little hard to get them lower. Nobody's figured out how to get them negative. So I don't take exception to the point that monetary policy may be close to the limits of what it can do. If you look at, I forget whether he called for more fiscal spending in that same statement, but that's the view that many people would take, that it'd be much more effective to do more spending or more tax reduction, run a bigger deficit. Whatever the merits of that case, it's unlikely to happen because a friend over here on the Tea Party isn't going to let that happen. So there isn't much prospect of that. Everything goes back to the wisdom of a little patience. There's nothing that's going to cure this situation that I know of in the short run while these underlying adjustments.
I think on fiscal policy, is the British approach of cutting down correct, or the American approach?
That's right. You can take the opposite view and say, we don't want any traditional stimulus at all. We're going to reduce the budget deficit. And I suppose you could say raise interest rates a little bit. Yeah. Well, we're going to see that real live experiment with the UK. It's very interesting, but that runs against the core of standard macroeconomic theorizing for years. And we'll see how it's got more support in the UK, obviously, than it's got in the United States, although it's got some in the United States, too. But I don't think any government in the United States is going to take the risk of tightening fiscal policy right now. What you could do, and it's a real question. What action can you take now to reassure people that you will tighten up on fiscal policy in the future? There's one thing you can do there. It should have been done already. One of the things that people worry about in the future is how you pay for Social Security. That is a soluble problem. And you can't change it in the very short run. You can't take away benefits or increase contributions right in the middle of the recession. It's something that's got to be worked out over decades. But you could take the action now to assure that it will take place over decades. We did that about 30 years ago now. We had a reform of Social Security that said it will make Social Security in the United States viable for the next 50 years, which it did. It's 30 years now, but it's still viable at the moment. But people are worried about the next 50 years. And I think it's unfortunate we haven't dealt with that problem already. Not that it would dramatically change the situation in the short run, but it would be a great demonstration of the fact that we are willing to take action to restrain unsustainable entitlement programs. And the big one, of course, is Medicare, medical health care in general. And I don't think anybody's really satisfied we have the answer to that.
By the way, we have about 5 minutes, so we've got to rush a bit. So if you don't mind, lady over there, please. Yes.
My name is Adele Chen from LKY. And thanks for Professor Kishore bringing the question is, what Chinese think they can do or U.S. can do to change U.S. economy deficit problem? My question is, instead of the U.S., instead of telling Chinese what to do, for example, raise the currency to solve their deficit problem, is that possible for USA? Ask Chinese what we can do together to solve the deficit problem. Is that possible?
The question is, instead of the United States lecturing China on what to do, what can the US and China do together and work together to solve the problem?
I notice China is doing a little lecturing of the United States as to what to do, too.
He's saying that China is also lecturing the United States now. Well, it's a bit of tit for tat.
We don't accept lecturing. That's well, this is obviously the question that we would like answered. And ultimately, there's going to be responsibility on both sides. It's been maybe too much concentration on the exchange rate question, but to the extent the United States has been following unsustainable policies with respect to consumption and deficits, the onus is on us to change. To the extent that China or Asia has been following unsustainable policies with respect to restraining consumption and over-investing and running surpluses, it's up to them to change. If we both change, we can hold hands and happily go off to a more prosperous future. And we need all those, you're at the LKY school, I take it.
Yes.
Well, that's what you learn at the school, and we need that leadership to bring us together to...
The Lee Kuan Yew School will solve all this.
I'll make a general statement which won't satisfy you, won't satisfy anybody, but because of these problems, I think it's fair to say there is a failure in the international monetary system. There's a failure of international governance that people are beginning to recognize. But if you think there's an easy answer to that, it's not easy. I've been through that for some time, but we ought to be trying again. And that's why we have all this G20, that's why we have discussion of exchange rate changes and or lack of exchange rate changes. This is all not going to be solved in a hurry, but at least people are beginning to talk about it. And in a way, the rise of the emerging world doesn't make it any easier, or let me say the decline of the United States relatively doesn't make it any easier, because the more people that are at issue here, the harder it is to come up with a joint answer. So it's a real challenge for political economy. It's a huge challenge of how you run the world with so many actors.
Well, you know, it's already coming to 6:30. Shall we carry on for just for 5 or 10 minutes? Do you agree? What I propose we do is, if you don't mind, we'll just take each one of you lining up. Just, if you don't mind, state your question briefly. And Paul, if you don't mind, we just take notes of the questions, and then maybe you can sort of round up and answer some of them, or all of them, if possible.
That's what this pad is for.
Yeah,
huh?
that's what this pad is for. So can you start, but if you don't mind, short, sharp, crisp, and identify yourself, and then we can go around and get all the questions, and then we finish. Yeah.
Thank you, Dr. Volcker. My name is Nirwan. I'm working for UBS Wealth Management. My question for you is, in about 2 days, the Fed is going to announce a massive QE2, while in Europe, the ECB is resisting any notion of QE2, given that the growth outlook is not any better than the US, if not worse, with the peripheral countries. What is your view about this discrepancy in views between the Fed and the ECB? And wearing your former Fed chairman hat, what would you do?
Okay. Next, why don't you take your question and we can go around? Yeah. Please, quickly.
Jeff Smith, also American, but longtime resident of Singapore. Dr. Volcker, very enjoyed much your presentation, your discussion today. Since I'm only allowed one question, I won't ask you, when you were Fed chairman, did you go and visit the gold in Fort Knox? But I do think that you were present in the room when the decision was made at Camp David to suspend the U.S. redemption of dollars in gold in 1971. Now we've been on a almost 40-year experiment whether currencies not linked to a physical commodity can be efficient and stable as a monetary system. When you were a central banker, if you were still a central banker, I wouldn't have any worries for managing such a system. But now we have to rely on the brilliance of your successors. Do you think that such a system can be successful over the long term?
Okay. Next question.
My name is Jeremy Donaldson. I work for IBM in the financial services sector. My question is this, just picking up on something that you said, Dr. Volcker, earlier in your speech about the great minds, or many of the great minds, moving from the sciences into getting into financial engineering. Is there a way that universities such as this and universities around the world and other institutions around the world can sort of incent people to take that innovative thinking and channel it back into the real economy to get the balance back that you were talking about?
Thank you. Next one, please.
Good evening, Dr. Volcker. My name is Walter. My question is, for the past 15 years, the financial market has moved from one bubble to another. We started with the dot-com bubble, and then we moved on to the housing bubble. And now with the talk about QE2, there seems to be the start of a gold bubble. So if that one bursts, what are the troubles ahead for us?
Okay. Hi. Good.
My name is Robert. I'm a
Good.
student.
Why don't we stop?
Hey, one more question. Last one. Last one. You can remember 5 questions.
No, I can't.
Go ahead.
Okay, I'm lucky. My name is Robert. I'm a student. And basically, the question I want to ask is that the current crisis has shown that the financial system is no longer a US or China thing. It's now a global thing. So even though there's a G20 now, is there any serious talk of a internationally integrated sort of financial regulatory body? Doing more than just what the IMF and the World Bank is
He's saying, is there a talk of a new international integrated financial regulatory body? Can that happen? Yeah. So I think you got the questions. I got the 5 of them.
Well,
just be brief and brilliant.
Well, yeah, brilliant. And the question that worried me the most was from the guy that said he wouldn't worry if I was there. That didn't show a very intelligent approach. You got to work. Look, where are we?
QE2.
Massive QE2. Discrepancy with Europe. you know, both central banks provide a lot of assistance, and I don't think I'm going to comment on just what each should be doing. I don't know they're going to get a massive QE2 anyway. The word massive, I don't know. But let me just point out there are lots of problems in Europe. There's no Tea Party over there. A different kind of Tea Party I'm thinking of, right? I mean, it's not, they've got lots of big problems within Europe and very divided about how to deal with them, and a lot of problems in connection with the euro, as you know.
Will the euro collapse?
Well, I do not believe so. I'm a great supporter of the euro, but it's a lot of tension. And they are doing their best to prevent the collapse and providing a lot of assistance of the kind they said they would never provide. They come right up against it. Central bank is buying a lot of bonds. Come to think of it, they don't call it QE2. They're buying a lot of bonds of countries that are under pressure. So they got their whole. I never went to Fort Knox. I was tempted to at times, but I kept getting assured that the gold was really there. But don't make any difference. We don't use it anyway. So, I mean, it's all kind of an imaginary thing. We just pretend it's there. I don't think there's any real chance of going back to the gold standard. Indeed, the action of the gold market with the instability, the speculative pressure that reflects in itself, I mean, almost disqualifies the idea that we would expose currencies to that kind of potential speculation. That doesn't mean using fiat currencies of what we have does not require a lot of discipline, or that will explode. And that's why you have independent central banks, in hope and expectation that strong and independent central banks will be able to manage a fiat currency with a reasonable degree of stability. And you ought to concern yourself with that, because it's not automatic. And whoever is the head of the Federal Reserve or any central bank, you ought to worry about and encourage them. Balance back. Yeah, in universities. I think the only way you're really going to get the balance back is have a feeling that it's no longer so overwhelmingly attractive to go into finance, which has been the case for the last 10 years. And that's been fed by universities. They love it. You know, people will pay big tuitions. Business schools promote this stuff. They have promoted this stuff. There's a lot of responsibility lying with business schools and their inability to see through some of the excesses of financial markets and to exert some restraining influence instead of educating people to contribute to it. Now, that's a sour view from one view. Bubbles burst. How did I forget that question?
.com, gold bubble.
What?
You said that now with the QE2 there will be a gold bubble.
Yeah,
What
well,
happened?
yeah, so there's a risk of creating more bubbles. I don't disagree with that. Somehow, the comment is perfectly right. We've had more bubbles every few years. They seem to be getting closer and closer together. You would think that the great crisis would dampen that. I think it has, but if money is too easy for too long, we'll have more. International bodies, and we haven't got any international body strong enough and coherent enough to exercise through its judgment discipline on national states, particularly big national states, and I include in that the United States, but I also include many other countries. You know, you haven't got international organizations strong enough to overcome what necessarily would be giving up a lot of sovereignty. The fact is, the international organizations are not very good at coming to a coherent, enforceable view, even if they could enforce it. Because there are differences of opinion. And the older I get, the more skeptical I get of the chances of putting together international organizations that can really consistently exert discipline. I don't think the United Nations can do it. We've seen that repeatedly fail. Right now, the IMF has some authority, but nobody thought so 5 years ago. Who was interested in listening to the IMF? And I don't think that's going to change. I understand that the membership of these organizations ought to be revised to reflect the changes in the world, but I don't think that's going to make it any easier to come to decisions. It may make it harder. And I don't think there's going to be any magic by reshuffling the executive board of the IMF or the World Bank. And that will suddenly become then a very much more effective institution. Should be done, but don't kind of adds to the legitimacy of the institution. The UN has all the legitimacy in the world. They've got 192 members and an inability to act very effectively on anything. Partly because they have 192 members. No easy way around this. The world is, I can't end up this thing. The world's coming to an end. The world isn't going to come to an end.
Okay, say something cheerful at the end.
Yeah,
come
well,
on. Let's cheer up the audience.
Well, let me say, I think we can manage. The cheerful thing at the end is we're going to survive, flourish, for a lot of reasons, technological advances, most importantly, without any international organization with the authority and the power to instruct all these countries to what to do. So that's good news, I think, basically, because it's not going to happen anyway. But we do, I think we need more thought about monetary reform, and that is a form of international agreement. See whether we can reach an agreement, get a little more discipline into the system. I'm all in favor of that. And I am optimistic that people are thinking harder about it. At the end of the day, whether you make a new institution or use the existing institutions, they do have a function, but they're not going to, by themselves, run the world, I believe. The national state is still here for a while. My lifetime, even in your lifetime.
Well, ladies and gentlemen, I'm not so sure whether we found all the answers to the questions that we've been obviously trying to address, but I'm sure you'll agree with me that as a result of our conversation with Paul Volcker, we've had many new insights and many new ways of looking at the same problem. We may not all agree, as you can tell. We have some people here in this room who believe the Tea Party will solve the problems, others who believe that they will not. But the whole point of such a discussion here is to see whether or not we can get a better understanding of the scale and intensity of the problems that we're dealing with. And for this, please join me in thanking Paul Volcker.